So hello everyone. I think all of you who are watching this video will agree that the world is a plethora of knowledge, and it is very important that we keep making efforts to gain this knowledge, even though it is not 100% possible given the quantum involved. But even a little amount, if we can grasp, it gives us a competitive advantage over our peers if we want to grow professionally and personally as well. And this is the exact objective of mine behind opening this channel and giving you the best quality content possible. So, what I've done right now is that I have made an attempt to gather some unique and valuable information or rules that I have found of profound importance given by knowledgeable authors of very best selling books. And see, reading just gives you a different perspective in life. It brings out the things that are there in the back of your mind subconsciously, which you cannot get in front by your own. And by reading it, the content of these authors, that zone just pops up, and then you are able to think more clearly and use it to your best abilities and do well for yourself. So, without further ado, I'll just quickly start with the video. The first concept which I want to discuss is mentioned in the book Real Estate Investing for Dummies. It is basically for real estate investors that the author has suggested that whenever you're making a real estate investment, not for personal use, but for earning a capital appreciation or any amount of income from that particular property, that has to be at least 1% of the amount that you're investing. So if you're buying a 50 lakh property, you should expect to get at least 50,000 of rent from that particular property for you to come to the conclusion that you have make a financially good decision and you're making the appropriate and adequate amount of money out of that particular investment. Obviously, it may not be practically possible to always earn 1% in all the geographical jurisdictions, but 1% is the target where you need to be if you're not there already. And you should make consistent efforts to reach that target. And obviously, with the year on year appreciation in the property value, you should adjust your income that you will charge from the tenant so that you meet the 1% criteria. So, this is what the author suggests. Next, coming to the book, The Barefoot Invest, it's a very good book. I was trying to read for a very long time, but due to paucity of time, maybe it was not possible. But finally, I managed to read it, and I would recommend all of you to quite kindly read it at least once. This concept of 3 day rule is basically preventing impulsive purchases. Now, impulsive purchases can be influenced by a lot of things. It can be done by friends, by a reel that you saw on Instagram, or anything. Your friend bought the latest gadget and you think that it can be useful for you also, without introspecting and seeing that the substitute of that is already available with you. You buy that asset and you make an impulsive purchase, and then after 3 4 days you realize that I could have done better, I could have not purchased this and avoided this. So the author suggests that you wait for a 3 day period and then see if you actually need the product. There have been counters against this principle saying that it should not be just 3 days, it should be a 30 day. But I think practically 3 days is a better period because you should not delay the process of decision making. And practically speaking, I have personally experienced it after 1 or 2 days after buying the product, I felt that this is something which I could have easily avoided. So if I would have waited for this 3 day period, I would have saved on that money and I would have, made good returns out of it. So that way, it is very uh, prominent in our day-to-day lives. Now it depends if you want to resort to 10 day, 15 day. That is completely customizable, and you can set the amount as per your own financial, convenience. If you need to set a threshold beyond 10,000, if anything you're purchasing, that is a material purchase for you, or above 5,000 is a material purchase, or above 1,000 is a material purchase, based on your financial parameters and the way you function in life. Next is a very popular concept of averaging or dollar cost averaging, because the book has been written by somebody who is not from India. The Little Book of Common Sense Investing is the name of the book. Averaging is a very common concept. Let's say, for example, I buy a stock in the Indian stock markets of 1,000 rupees, and the next day the price of the stock falls to 900. So the price was 1,000 initially, and now it has fallen to 900 rupees. I would then worry that should I sell or should I hold? But I'm very sure after in 5 years the stock is going to give me good returns, so I would rather want to hold the stock. So what I'm going to do is I'll buy another quantity of that stock for 900. So now my average cost becomes 950. 1000 plus 900 divided by 2, 950. Again, next day it falls to 800. So I buy one more quantity of the stock. So with every falling prices, I am buying one more quantity of the stock. So it now becomes 2700 divided by 3, 900 becomes my average cost. So this is just equivalent to buying three quantity of the stocks on the second day itself. And then so now my average cost becomes 900. So actually the stock that I bought for 1000 is representing average cost of 900. So now that way this has become the decrease in stock prices. I try to leverage it in my own way and try to reduce my average cost, so that now when I sell the stock next day when it becomes 1100, I'm at an overall profit. So this is the concept of dollar cost averaging, and it is a very prominent concept which is followed by almost all people who are into the markets for a very long period of time. Next, coming to a very good book, I recommend all of you to, out of all the books that I'm going to mention in the presentation, I would definitely recommend that you at least read this book, The Total Money Makeover. It is going to change the way you think, your perspective about money. It is going to, like, you'll find a lot of difference in you, which I personally found a lot of differences in the way I think, and I think it is a very prudent side of me that has come out after reading this book. So please do give it a read. So the first method that is discussed in this book is the debt snowball method. So whenever we try to throw a snowball from a mountain, initially the ball is small, but when it rolls down and then it is accumulating ice, it becomes a larger quantity, and the mass becomes large. So the idea behind this, the name is suggesting that initially you're giving small efforts, but then it is giving you a bigger impact. Now, what it is exactly is that it says that if you have multiple debts, you pay the lower amount of debt first. I mean, you put in all your funds to pay the lower amount of debt first, so that you are financially, at peace, that one debt is clear, and then you go towards the higher debt. Now, how do you practically do it and how it is beneficial for you? Let me just take a numerical example and try to explain that to you. So this is a hypothetical scenario where there are two debts involved. One debt has been taken at 15% interest, and another debt has been taken at 9% interest. The first one is a lower debt, 10,000 rupees, and the second one is a 1 lakh rupee debt. The EMI is coming to 347 rupees for a total of 36 installments, and for the other one it is 2076 for a total of 60 installments. Now I know that I can only pay 3,000 towards debt repayment out of the financial allocations that I have made. So if you total these two EMIs, you will find that you have to pay a total of 2,423 rupees out of for both the debts every month. But you have 3,000 rupees you have calculated. So what you should do is the extra 577, 3,000 minus the sum of these two EMIs, you should pay, since the rule says that you need to pay towards the lower amount of debt first and try to clear it. This 577 you will use to repay this 340, this 10,000 rupee loan first. So once you do it, you can do it manually and check it by making an amortization table in Excel or whatever, that your number of installments will reduce from 36 to 16. And for the 1 lakh rupee loan, what you will see is that initially, since you're paying the surplus amount in the first debt, you will not be able to pay the excess amount in the second debt. So you will be paying 2076, which was the original EMI for the 16 installments when you're finishing the first debt. But instead of the 44 debts, 60 minus 16, 44 installments that will be remaining, you will be able to repay the loan in 32 installments if you put in the 577 surplus funds plus the 347 surplus fund, the not the surplus fund, but the EMI that you're paying for the first debt into debt two as well. So ultimately, you're making the debt one EMI in debt two also, not thinking that debt one is over. Now my EMI is done, so let me not, use this money somewhere else. The author is saying that you try to clear your debts and become debt free as soon as possible and try to repay it. So then your number of installments get reduced from 44 to 32. Now, people may argue that there is opportunity cost involved. If I use the EMI of the first debt and put it into the second debt, then I am losing the interest that I could have earned by if I could have invested that proceeds somewhere else. But try to understand, you're also saving interest of 44. Initially, you would have to pay 44 installments. Now you're paying 32 installments. So 12 installment interest also you're saving, right? So you need to a cost benefit analysis and see which alternative is better for you. If by investing the first debt EMI in somewhere else rather than repaying the second debt is more beneficial, you can obviously do that. It's a financial decision. But the author has historically said that this can be a better approach of dealing if you have multiple debts, which otherwise financially is a very big red flag. I think dollar cost averaging also I took an example, but I think I've been able to explain it, so it should not be a problem. Yeah. Another rule that has been mentioned in the book, The Total Money Makeover, is that you have to maintain an emergency fund of minimum 3 months of your basic expenses to 6 months of your maximum of a 6 month of your basic expenses. I'm sorry. So if your basic expenses are 50,000 rupees per month, you need to at least maintain a buffer fund, which is you'll call it as an emergency fund, which in case of an adverse event or a contingency event you can use and without being concerned about whether you have the funds to maintain your basic expenses or not. So 1,50,000 is the minimum amount. 50,000 into 3 for 3 months is the minimum amount, and 50,000 into 6, 3 lakhs is the maximum amount. So the range is 1.5 to 3 lakhs if you have a basic expenditure of 50,000 rupees. So this is what has been suggested, and obviously, as financial scholars mention, there is always a need of maintaining an emergency fund. Just the quantum has been quantified in this particular book. Next, coming to the book, The Intelligent Investor. It is a very popular book. A lot of people know about this book and must have read it already. And it talks about a very popular rule of 72, 114, and 144, which is nowadays taught in school as well. It can in fingertips tell you in what period of time your sum of money that you have invested becomes double, treble, or quadruple. So you just that you need to know how much amount of return you're expecting from the investment that you're making. Let's say, for example, you are investing 1 lakh rupees and at a rate of 12%, mutual fund is giving you 12% return. So if somebody asks you what is the duration in which this 1 lakh will become 2 lakhs, so you don't have to calculate, apply the formula of interest, simple interest or a compound interest and see that, it will double in 6 years, but you can just do 72 by the rate of interest that you're earning, 72 by 12. So you can easily say in 6 years, my sum of money will double. Same applies for 114 when you can say 114 divided by 12, which would roughly be around 9 point something, will be the amount of time and my sum of money will become 3 times. And for 144, you do 144 by 12. And so you'll come to the conclusion that in 12 years time, your sum of money will become 4 times, which means quadrupling. Next, coming to a concept which has been discussed again in this book is margin of safety. Margin of safety is where the author says that scientifically it has been proven that if you buy a stock, let me take a numerical example and try to explain this to you. If by your fundamental and technical analysis or your financial advisor has made a research and said you're getting pretty research done for a particular stock in which you are very bullish, and the consultant has told you that, or you have you have the knowledge and you have made financial models and tried to come to a conclusion that the price of a particular stock is going to be 1,300, but right now it has been priced in the stock market at rupees 1,000. So now based on your analysis you expect a 30% appreciation in the stock price, right? So anything from 30 to more than 30 is acceptable as a margin of safety, and you can invest in that stock. If either it was predicted that it will only grow to 1,250, so appreciate to 1,250, which is a 25% appreciation, then it is said that the margin of safety threshold is, not met. So you should not invest in stock, because I think because of some scientific parameters which were not being, which were analyzed by the author, he said that if the margin of safety is less than 30%, then it is a higher probability that your research will not be held valid, and the stock chances of your stock price going lesser than the amount you invest is higher. So you always keep a margin of safety of 30% before investing, but practically again, it cannot always be the case that you can expect a 30% return out of a stock portfolio. If otherwise, then a long-term view that you're planning to take. In short term, there will be very less likely cases where you can expect a stock to grow by 30% unless there is something very good about the stock or the business is doing really well. Next, coming to a book called Your Money or Your Life, which talks about mainly strategies which you should resort to when retiring. So the book suggests, the author suggests that you just back calculate the amount of corpus that you need to create till the time you retire. And how do you back calculate this? By estimating the monthly expenditure that you will be needing after you retire. let's say for example it is 25,000 rupees per month that you will require after retiring, because after retiring then your wants also get limited. You just need to live a basic life, but your health expenses may increase. So 25,000 rupees, you know, your basic expenditure would be monthly. So for a year, it would be 3 lakh rupees. You multiply this with 25, so it will give you 75 lakhs. So you need a 75 lakh corpus as on today. 75 lakh as on today may not be the same amount after 30 years. So you need to accordingly adjust for inflation as well. And then try to create an SIP or an investment plan so that you reach that amount after whatever amount of years so that you reach the retirement age. And this is again called the 4% withdrawal rule, which is very popular concept. So from this only the 4% thing is coming, because if 25 we are multiplying with the annual expenditure, so 100 by 25 is 4%. So both are interlinked. Either you call it the 4% withdrawal rule. In the book, it has been mentioned as the financial independence number or the FI number. Next, coming to the 80-20 rule, a Pareto principle is nowadays taught in schools also, and everybody is very, uh, very well aware of this. I think the person was Wilfredo Pareto, if I'm pronouncing his name correctly, or if I can recall correctly. So what he said is that, he noticed in different spheres of life that 80% of the things are only responsible for 20% of the outcome, and 20% of your efforts are responsible for 80% of the outcome. So he mentioned that 80% of your customers bring 20% of your revenue, and 20% of your customers bring 80% of your revenue. So you should try to focus on these 20% customers who bring 80% of your revenue, because these are the major customers. Maybe they are giving bulk orders. So you need to, focus, get your attention more towards these 20% customers and try to keep them more happy. I'm not saying that you dissatisfy the 80% customers, but you need to be a little more skeptical when you're dealing with these 20% customers who are bringing 80% of your revenue. Similarly, in life, you will notice that I can also personally vouch from my personal experiences that when I'm working on something, 80% of my time I'm spending on administrative things, which is only going to promote to, cater to 20% of income that I will generate. And 20% of my actual, technical time is going towards getting the major part of my revenue, which I'm focusing on core work, 80% of my work. So by this I need to analyze that, what is this work that I'm doing by devoting 80% of my time, which is not contributing to more of my revenue, which I need to cut down and need to focus on more of that particular amount, that particular work of mine, which is going to generate more revenue to me. So this is just like an introspection, the 80-20 rule, where you see whichever quantum is giving me more beneficial outcome, I will try to focus my attention more towards that particular thing. This is what Wilfredo Pareto also said, and he tried scientifically explained also. One example was that customer one, which I was not able to recall earlier, but I mentioned, and there were other examples also which he gave. So this is the concept which has also been discussed in the book The Millionaire Next Door. Next is All Your Worth. I mean, it's a very popular book, and it has discussed a very popular concept which I think can be customized easily. So it's the 50-30-20 rule. Out of the total monthly investments that you have, the monthly income that you're generating, 50% should be catered towards your basic expenses, which cannot be avoidable. Groceries, it can be anything. Expenses which you have to incur. 30% is the next segment, which can be avoidable, but you're doing it out of your own self wanting it. You want to go out, you want to spend some time with your family, you want to buy a gift for your family. Whatever it can be, you're buying something for something which is not a basic product, but something that could have been avoided, but you need to buy just because you want it. Outings, gifts, luxury items, whatever. And 20% should go towards debt repayment and investing. This 20% also you can break. I always recommend that the investing portion should be higher than the debt repayment. You can take a 12%, 8% split, 12% investing, 8% debt repayment, or a 15-5 as well. But unless you have a very huge amount of debt because of certain, contingencies that had to come and you had to take a loan, or some people who have taken a housing loan, for example, the housing loan quantum is actually the major part of the salary people earn for salaried employees or whatever, and people into so the housing loan EMI is a bigger amount generally, so that is towards debt repayment. So that threshold can be met. So you should try to stick to this rule. And if you're seeing that the housing loan EMI is not, exceeding my 20% threshold, then you should think twice before actually taking a loan if it is required or not. Maybe you can follow the 3 day rule in this. A 3 day rule may be a shorter period in this case, and you have to think for 10 15 days before you actually buy a house. So I think that was all. And there are more than 200, 300 rules mentioned in all the books, and these are not the only books, but I could relate, or I have seen people applying these rules in their lives, and I have seen differences or different results being achieved either in my life or with others following it. And that is why I thought that maybe you guys should also try to peruse these rules and try to make a part of your decision making when you actually take any financial decisions or whatsoever manner possible. And I hope it brings the best out of you and it can help you in any manner which you may feel is beneficial. So I think thank you so much for watching till the very end, and I hope that you guys can take out some time and read the books mentioned in this presentation because they are worth it. Thank you so much.